So Jamie was kind enough, and I appreciate him coming on with us today and talking about what Cincinnati Life does from an annuity perspective, which we don't really look at them a lot globally. But they have some really cool products that are a little more old-fashioned, but that's what we like, the simple, easy-to-understand stuff. So, Jamie, why don't you go ahead and start with what you guys have. I mean, a little bit about you, what you guys offer in terms of product.
Absolutely. Thank you, Mike, and I appreciate you all taking the time to get together today. I know you're busy and you're trying to run a business, so we appreciate it very much. I am the National Annuity Director with Cincinnati, as Mike mentioned. With our annuity portfolio, and Mike kind of alluded to this, the models are somewhat antiquated, but I think what you'll find is that can be a good thing, particularly in the world we're living in right now. So the annuity products that we have 3 products. We have a single premium deferred annuity, we have a flexible premium deferred annuity, and then we also have a single premium immediate annuity. And Mike, I do have an idea on the SPIA that we can talk about in a little bit to kind of piggyback on the idea that you were sharing earlier. Sure. So Mike mentioned that, ours works a little differently in that with our annuities, the majority of our business goes into the single premium deferred. We're starting to see a pretty nice uptick in the flexible premium deferred. But when we talk about them being somewhat of an antiquated model, they're not, the multi-year guaranteed annuities where your surrender charge is going to match your rate. Basically, the way ours works is with our single premium deferred, it's a 7-year surrender charge schedule. Starts out at 7%, goes down 1% a year. So we guarantee you a rate. In the first year, you're going to have a declared rate. After that, you're going to float with the worst-case scenario of 1%. Now, I've had people say to me, well, Jamie, if rates start going up, maybe that's a good thing, but, my customers and I'm worried about getting burned on renewal rates, which I completely understand. I mean, I've been with Cincinnati for 2 years, but I was an annuity wholesaler for 20 years before that, and I'm very familiar with the renewal rate process and the concerns of saying, hey, well, if I'm looking at a 7-year product and you're telling me after the first year, I know I'm only guaranteed 1%. I'm not sure if I'm comfortable with that. So what we can do after this meeting, I would be happy to share our renewal rates with Mike, and he can send them out to you if you want to take a look at them, because the proof is in the pudding. But there are a couple of things to think about with our model. First of all, yes, there is a 7-year surrender charge schedule, but one of the things that makes us unique is we have a return of premium feature. So if someone were to buy an annuity and they decided in 2 years, you know what, I made a horrible decision, I want to get my money back, we'll look at the surrender charge schedule. If that surrender charge would invade the principal, we won't apply that. So we would just take back the interest at that point. So if someone decides to cancel, we're going to look at that surrender charge schedule, that percentage. We're going to look at a return of principal. Whatever is going to guarantee they get back at least what they put in is what we're going to give them. So what we're hearing from agents who are having success with our product, why they like it, why their customers like it, when I say, hey, thank you for your business with Cincinnati, what sets us apart, that return of principal feature comes up pretty regularly.
And Jamie, that's on both products?
That's on both the single premium and the flex, yes. And I'm glad you bring that up, Mike, because one thing with our flexible premium annuity that is really kind of unique is it's a 9-year surrender charge schedule as opposed to the 7, but when you add to it, subsequent additions do not incur their own surrender charge schedule. So we stick to that original 9-year schedule. So give you an example, someone could be 9 years into it, they're still adding to it, say it's $25, $50, $75 a month, whatever it may be. Those new additions are not adding a surrender charge.
That's nice. Question for you about is the liquidity on these products. Do you have the 10% per year type deal?
Yes. So in addition to and I'm talking about both the single premium and the flex here, in addition to the return of premium feature, there is a 10% of the contract value available every year. Now, we allow that in a one-time withdrawal. So with our product, they couldn't get set up to where they draw the interest monthly, but if they want to take up to 10%, they can do that annually, and that's available in the first year.
Okay, gotcha. So they're pretty classic traditional products, honestly.
Absolutely. These are the products that I started selling 23 years ago when I got into the annuity business.
There you go. Yeah, there's not many of these anymore. Are there any kind of waivers for nursing home or confinement on these?
Yes, good question. We have a nursing home and terminal illness waiver, or nursing home hospitalization and terminal illness waiver. The way it works is if the customer is in a nursing home for 90 days, a hospital for 30 days, or if they're diagnosed with a terminal illness, the surrender charges are completely waived at that point.
Very nice. I mean, we talk about how this is kind of an old-fashioned traditional product. One of the things that's kind of not necessarily traditional, but not regular that you guys do is you credit using portfolio rates. Could you explain that a little bit for everyone?
Absolutely, absolutely. Yeah, we use a portfolio-based pricing methodology, and this is vitally important. When I was talking before about the renewal rates, and you're saying, hey, you're going to give me a rate for the first year, then my worst-case scenario is 1. How do I know I'm going to be taken care of? Like I said, number 1, I'm going to follow up with the renewal rate history. But with a portfolio-based pricing model, the way that works is we have a history of renewing new money the same as old. The reason that we do that is to simplify the process. Now, keep in mind, I work for Cincinnati Life Insurance Company, but we're owned by a property and casualty company. Right? These products were designed probably 30 years ago to initially cater to our property and casualty distribution, and they wanted to keep them basic, keep them simple, because people have needs for annuities. Property and casualty agents have customers who have needs for annuities. They wanted something basic that the customers could understand. So with that portfolio-based model, rather than a situation where every time, many carriers, every time they declare a new money rate, let's say the 10-year Treasury rate keeps going down, and they were offering 3%, now they're going to start offering 2% for new customers, they would basically cut off that portfolio, that pool of bonds, and set a new renewal rate crediting strategy for this new bucket. We keep them all together. So existing customers, new customers, we have a history of renewing them at the same rate. So I'll give you an example. In a declining interest rate environment, I'm sorry, Mike, go ahead.
No, that would be good. An example would be great.
So in a declining interest rate environment, it may not work to your favor. I'll give you an example. Right now, we're at 2.4% on our single premium deferred annuity. A year ago, rates were still low, but they were a little higher. We were at 2.8. So if somebody purchased an annuity a year ago under the portfolio method, they're going to renew now at 2.4. Conversely, if rates start going up, if we're offering 3% on new money a year from now, that existing customer, while we can only guarantee them 1%, under the portfolio pricing model, they should renew at 3. So in this interest rate environment, this model may prove to be beneficial for the customer, because if they're in the boat with us, they should rise with the tide.
That's exactly right. That's a very nice thing to think about there. So that's what you have on the deferred front. You guys also have a pretty nice SPIA, too. Do you want to talk about that for a little bit?
Absolutely. We do have a single premium immediate annuity, and it's, again, very basic, very antiquated. You put your lump sum in, and we give you a list of settlement options that you choose from. Now, immediate annuities, and Mike, I'm glad that you wanted me to talk a little bit about these, and you were talking about them before. Annuities are fantastic. They have, fed my family for over 20 years. I love deferred annuities because the safety, I love the tax deferral component. But when I'm talking with customers, I always talk to them about, what is the end game here? The reason I say that, while annuities are a great conservative savings vehicle, the tax deferral is wonderful, probate avoidance is great, not always the most efficient wealth transfer vehicle, which we all know that life insurance is going to be a more efficient vehicle. So annuities were designed for income. Some people are taking income now, some people are taking income in the future. It's kind of as a side note, not that anybody cares, but I went to a small liberal arts school, and my major was ancient and medieval European history.
That's totally normal.
It's totally normal, and I go work for an insurance company, right? The reason I share that, I first learned about annuities in a history class. Annuities have been around since the days of the Roman Empire. It was a program called annua. Citizens would give a lot. They would be 40 years old when they're ready to retire. they would give a lump sum over to the government would guarantee them an annual payment based on their life expectancy. So annuities were designed for income. They were designed to supplement income. I mean, right now, we're talking about 2,000 years ago, right? Let's fast forward to where we are now. Social Security is not going to cut it for most people, right? It's only going to cover about 35% of a retiree's needed income. Traditional pensions are all but a thing of the past. Some people have them, but employer pensions are not as available as they used to be, and there are 10,000 people a day turning age 65. So if you look at it this way, Social Security is not going to cut it. Pensions aren't there. We need to supplement our most of us will need to supplement our retirement income with our own savings. An immediate annuity, is the only way to do that. So, I'm a huge believer in the SPIA process. Immediate annuities are fantastic. Kind of, to piggyback on the idea you were talking about before, Mike, I was on a conference call with LIMRA earlier this year, and a staggering number kind of jumped out at me. There's currently $450 billion in deferred annuities that's out of surrender. Okay, so if you were to just randomly sit down with 10 of those customers and say, Mr. and Mrs. Customer, what is the intended purpose for these assets? Maybe 1 out of 10 would say, well, Mike, I'm 65 years old. I'm going to retire in 5 years. Social Security is not going to be enough. I don't have a pension, so I'm going to annuitize this annuity to supplement my retirement income. That's why they were designed, right? The other 9 out of 10 probably aren't going to say that. They're going to say, Mike, I like the idea of deferring my taxes, and I just want to pass this on to the next generation if something should happen to me. That's great. You can certainly do that. The annuity is going to avoid the probate process, but let's take a look at an IRA, for example. That's going to be 100% taxable to the beneficiary at ordinary income. And with the Secure Act that was just passed, unless they're an eligible designated beneficiary, they now need to liquidate that within 10 years. So here's an idea for you. If that individual, if they're somewhat healthy and you think they're insurable, you could maybe take those stale assets, as I call them, roll them into a SPIA, because you can't go from an annuity to life insurance, right? But you can go annuity to annuity. So take that deferred annuity, roll it into a SPIA, use those SPIA payments, which you will pay taxes on the payments, but you'll be able to spread out the tax implications to fund life insurance, to fund long-term care, to fund something else. And, give you an example. If you're using, a 10-year period certain to fund a 10-pay SPIA, use that SPIA to fund the 10-pay whole life policy. If you've got a 65-year-old male who's, a standard non-smoker, you've got $100,000 in an IRA, you turn that into a SPIA, say net of taxes, you're $8,000, $8,500 a year, fund a 10-pay whole life policy, you're going to be able to get much more than that $100,000 in the form of a tax-free death benefit, and you didn't find new assets. It was just an asset repositioning strategy for the customer. And I apologize, Mike, kind of going on a tangent there, but based on your idea and kind of talking about SPIAs, I thought that would be pertinent to share. I didn't spend a lot of time talking about our SPIA product because it's pretty basic. I mean, just like SPIAs work. You give your lump sum, you pick your settlement option. I don't want to paint Cincinnati into a corner, but what I will tell you, what I have found where we seem to be very competitive are between the ages of 70 and 80 for joint life scenarios. So I don't want to say we're not competitive in the other areas, but if you have situations that come up in that area, we'd be happy to help with a quote and
that's
see if
your
it's
wheelhouse right now. Gotcha.
Seems to be.
Gotcha. Well, that's great. I mean, we like the plain, simple type products, and I think that's what your SPIA is. It doesn't have any kind of like commutation option or liquidity to it. It's more of a classic.
It does not.
Right? Yeah.
Correct.
And that's fine. That's what we're looking for a lot of the time. But we did have a question for you that popped up on the deferred annuity products. Do they have a market value adjustment?
Wonderful question, because that's one thing that I didn't mention when I was talking about the benefits. We do not have an MVA. Not all fixed annuities have market value adjustment, but many do. So we've got the return of premium, no market value adjustment. A market value adjustment in a declining interest rate environment, it can work to your benefit. The rates are so low, if they start going up, somebody buys an annuity today, 3 years from now they want to cancel. If the interest rate environment is higher than when they purchased the annuity, they're going to get a negative MVA. So no, we do not have an MVA on our products. Thank you for asking that.
And it's very interesting that you have that on your product because there's some participation there with increasing rates. So that could be a pretty nice feature that you guys have. But
sure.
well, I'm glad that you could jump on with us today, and thank you. I know everyone's time's valuable. It's great that you could jump on and talk about income. Hang on, another question coming in.
Okay.
If the SPDA does not have a commutation value, does that mean they can be used as Medicaid compliant product?
Great question. Our particular annuity is not Medicaid compliant. It's not an MCA. There are other carriers out there that have them, but Cincinnati is not one of them.
Yeah, that's a good question. Yeah, you don't run into many of those old-fashioned design products anymore, and most of them have some kind of liquidity to them. But yes, I am glad you could jump on. I thank you again.
Appreciate your time. Thank you all.
On these calls. Yeah, and everyone's interested in income. And if you're not interested in income, you can always come here for the Jane Austen quotes and medieval history on annuities, which is always awesome. But if anyone has any questions, you can feel free to contact me, and I can reach out to Jamie for you. But I'm glad everyone could jump on, and I thank you for your time. And we'll see you next time on the Outcome is Income show. Thanks, Jamie. Thanks, everyone.
Thank you all for your time. Have a great day.
Signing off.